almost 10 a.m. here in Bangkok. Welcome to Bloomberg Markets Asia, coming to you live from the Bank of Thailand headquarters. I'm Haslinda Amin, and in just a few minutes, we'll be speaking exclusively with BOT Governor Suthiwartnarueput. The central bank just recently held rates despite public calls by the government to reduce borrowing costs. We'll discuss that and other challenges with him really shortly. And by the way, this will be his first interview in about 9 months. Let's do a check-in on how markets are faring with Avril Hong. She's on top of developments in the Lion City. Avril?
Yeah, Has. I mean, after that US surge overnight in stocks, it's 30th record this year. We're seeing tech is doing well in the Asia Pacific today, and overall the shares are also climbing, tracking that Wall Street rally. In a way, all this is defying those expectations or concerns that the breadth of the surge in US stocks is really narrow, confined in a way to those mega caps. We are seeing even in China as well as Hong Kong, the equities there recovering lost ground from yesterday that was sparked by concerns given the economic data, raising those worries about how the property sector is still a key drag. We're seeing the Chinese bonds continuing their climb on those expectations of policy support. Also wanted to highlight here what we're seeing in Japan. We saw gains in the morning session on stocks, but some pressure still on these Japanese government bonds. We hearing from Governor Ueda, and he signals that the rate hike next month still possible even as the Bank of Japan cuts its bond purchases. That's what we're seeing. But let's flip the board and take a look at Australia as well, because in the next hour we will get a decision from the RBA. It's expected to keep things unchanged and potentially come in quite hawkish because of sticky inflation, but that's likely to not be much respite for the Aussie dollar given how strong the US dollar has been, Has.
Avril Hong, thank you so much for that update. Now to our special guest this hour here in Bangkok. Joining us exclusively is the Bank of Thailand Governor Sethaput. Governor, good to have you with us.
My pleasure.
It's been a lot of back and forth when it comes to the pressure from the government to address inflation in the country. Give us a sense of how much has changed in terms of the inflation and growth story here in Thailand.
Yeah, we see growth and inflation gradually moving back to their long-term target levels. So growth, for example, we see gradually moving back to about 3%, which is where we see our long-term growth potential at, and inflation gradually moving back to our 1 to 3% inflation target range. In terms of our forecasts for this year, we see growth coming in at about 2.6%. Ramping up to 3% next year, and inflation this year is still on average a bit below target, but gradually going back into our target it'll come back into target within the second half of the year.
Some are optimistic though. Some say that perhaps you will have issues getting to 2.6% this year, 3% next year, because output remains really, really weak, way below pre-pandemic levels. And when you take a look at inflation, for instance, core inflation in particular, still lackluster, 0.4% year on year. That is not a good story.
Yeah. On the growth front, I have to say that we didn't change our forecast from this MPC compared to the last MPC. There's a headline GDP forecast that's the same, 2.6%. But in terms of confidence about the numbers and seeing that the outturn came out close to what we had initially forecast, I think we have greater confidence in that number. Confidence not in terms of like there's more upside to the number, but confidence that number is likely to materialize and the downside isn't there. Why? A couple of reasons. First off, the Q1 outturn came in actually stronger than we'd expected. I know the headline, Q1 year-on-year number didn't look good, 1.5%. Didn't look good from an optics standpoint. But you look at it in terms of quarter-on-quarter movement from fourth quarter. In terms of our estimates of the seasonally adjusted quarter-on-quarter number, it was a 1.5% quarter-on-quarter change, which is about twice the average level that we've seen in terms of quarter-on-quarter movement. So a pretty good pickup. And the other thing that we were concerned about was in terms of the second quarter, how it looks going forward. And on that, again, one thing that was a big risk was about how likely are we to see government disbursements coming out, and on that I think the news has been fairly positive. The initial numbers for second quarter also look fairly positive, so that gave us quite a bit of confidence again that trajectory that we saw was intact. Are there risks? Yes. Biggest risk I would flag would not be so much actually on the domestic front. We think the domestic numbers will be okay, but we do have some concerns, particularly on the export front.
You talk about government disbursement. Of course, the government will be meeting tomorrow to decide on the budget against a backdrop that is less than ideal. We have Prime Minister Sethaput himself, grappling with a political situation. We have former Prime Minister Thaksin also in a similar situation, potentially providing tensions within the country. Might your, targets be derailed?
That was one thing that we were concerned about in particular. There's obviously a lot of noise and whatnot going on, and we're concerned that would affect things like budget disbursement. But again, I think one thing that we've been very pleasantly and positively surprised by is the degree to which disbursements have come back on track. That's really, really very critical, because you look at our recovery and ask why was it kind of slower than we had anticipated. A lot of it had to do with that weak fourth quarter number. And that had to do, in no small part, to the delayed budget and the disbursements that didn't come out. So I think the fact that we've seen disbursements come on track at the kind of working level, we see Ministry of Finance being very focused on this issue, going ministry by ministry, making sure the disbursements go out the door. So I think the disbursement story, that story is relatively intact.
Is there a risk of deflation? That is not your base case, but some economists out there suggesting perhaps you could see sustained deflation of what we're seeing right now.
Yeah.
I mean, lackluster performance.
Yeah. Not a top of mind risk or concern for us. And I understand where that concern comes from, because we had negative headline numbers continue for quite a while. But we have to get, look underneath the hood, look at what was driving the numbers. A lot of it, the negative headline numbers, were due to government subsidies that were in place that caused the headline number to turn negative. But if you look also at kind of what other things you would see if you were in a deflationary situation, we don't see those kinds of things here in Thailand. So if you were in a deflationary situation, aside from low inflation numbers and whatnot, we'd expect to see a very broad-based kind of deflation. And if you look at the consumer basket, about 2/3 to 3/4 of it, all the prices are either stable or increasing. So it's not a broad-based decline by any stretch of the imagination. We don't see wage deflation. We don't see the deflation that causes people to postpone their consumption or whatnot. Consumption has been going at a very rapid clip. We had 7% growth last year, which is pretty much a record in terms of private consumption growth. This year, on track again for that 3-4% number that we're seeing. So the broader signs of deflation that we expect to see, we don't see. We look at a lot of underlying measures of inflation. Again, those don't suggest that there's this high risk of a deflationary situation either.
But the truth of the matter is that improvement has been pretty slow and mild. Could we see an acceleration later in the year, and how much of that might we see?
Acceleration in growth or acceleration in inflation? Okay.
In growth, especially this is an economy that's been growing at slowest pace among ASEAN nations.
Yeah. The recovery has been slow. There's no doubt about it. I think in terms of recovery from COVID, we're among the slowest to recover. And a lot of it has to do with the fact that we were so tourism dependent, and tourism took a long time to recover. So that's been slow, no doubt about that. And like I said, in terms of the trajectory that we had seen, broad contours are there. The recovery was kind of intact, but everything got a bit delayed because of that very weak fourth quarter outturn that we saw. In terms of going forward, in terms of the quarter-on-quarter momentum, as I said, we saw a very good first quarter pickup. That quarter-on-quarter momentum is actually likely to slow down as you go because it was so high and so much higher than the average. But the year-on-year figure, the optics, will look a lot better. So, for example, the year-on-year figure, and this has just got to do with math and base effects. We saw a 1.5% figure for the first quarter. Sorry, you're likely to see ballpark something like 2 second quarter, 3 third quarter, and something close to 4 in the fourth quarter. So the optics of that headline number that people pay a lot of attention to will look better. But again, in terms of the quarter-on-quarter momentum, we might actually see some slowdown in terms of growth. On inflation, though, I think the picture is quite clear. We're gradually moving back to our target range. Latest outturn was 1.5%. We're not wedded to that because we know it's likely to come down a bit, but it's going to come back and go back to a target range within the fourth quarter. The average for the first half of the year, headline inflation came out basically 0%. But for the second half of the year, it's about 1.1%, so back within our target range.
Let's talk monetary policy. We know that you're not guided, you've said time and time again, you're not quite guided by the Fed, although it's hard not to be guided by the Fed these days. You stood pat for 4 consecutive meetings, unlikely to move, perhaps move once, some say. What's changed? Has anything changed to drive that view going forward?
I mean, what's changed, as I mentioned, the forecast and everything we kept that the same. In terms of the outlook, the outturn was particularly for a fourth quarter a bit weaker. So kind of the broad contours are there, but things are a bit slower getting back to where we had anticipated. So that was one change. But as I said, in terms of the most recent MPC meeting, we saw that we had greater confidence in terms of the numbers that are coming out. With regards to the Fed, we look first and foremost in our flexible inflation targeting framework at domestic factors, growth, inflation, financial stability. But we are a very small, very open economy, so the exchange rate matters a lot for us, and capital flows matter a lot for us. So we obviously have to keep an eye on what's going on with the Fed, but an eye. We're not led by that.
The thing is, the Fed dot plot now suggests only one cut, possibly none.
Yeah.
That means there's very little wiggle room for you to move this year. Is that a fair assessment?
There's no mechanical relationship between what the Fed does and what we do. So it's not like we have this kind of...
Not unless your currency is under a lot of pressure, which it is currently right now down 7% year to date.
Yeah, second only to Japan, I think, as is often mentioned in the news articles written about Thailand. Yeah, there's no doubt that the currency, I think, has been depreciating. Volatility has been high. But we have no preset level for the exchange rate. And as I said, but we obviously have to pay close attention to it because the exchange rate matters a lot for a small, open economy like us. And the thing that we pay attention to more than the level are the movements. So we don't want to see movements that are excessively volatile. We don't want to see movements that are not driven by fundamentals. But if you look at what's been happening, a fair bit can be explained by fundamentals. A lot of it, obviously, by what's happening with global factor in terms of the Fed, but also, as you point out, that our growth outturn and whatnot has been weaker than other places. So that weakness is underpinned by some fundamentals. That said, I think the picture in terms of capital outflows, for example, is an improving one. Last year we saw outflows of 9.9 billion. This year, ballpark year to date, it's about 4. And you look at first quarter, it was like 2.8. Second quarter is about 1.2. So it's slowing down. So I think there's support for the currency going forward. The current account surplus last year, we expect it to basically double from what it was last year. So that'll also add support to the currency. And the other thing, Haslinda, is that in terms of our tolerance, I guess, the best way to put it, for exchange rate movements is higher than it used to be, say back in, the bad old days of 1997, because our external vulnerability is much, much lower. We don't have much external debt. Our reserves are higher. Current accounts in surplus.
So you're comfortable with where the body's right now? It's down 7% year to date among the worst currencies in Asia. You're comfortable with the movement so far?
When you say comfortable, I don't want us to pinpoint to a level again and say that we're fixated on any kind of level and that we're comfortable with this level.
But you're not too concerned about the movements in the currency?
When we look at the movements thus far, we see that they have been underpinned by fundamentals. I mean, there are reasons why they move the way they do. Sometimes the movement's been too volatile and we see some issues with market functioning. Because one thing is that the markets, not just in Thailand, but in a lot of emerging market Asian countries, is that the FX markets are quite thin. So when there are these big movements, there's the danger that sometimes things snowball, and so we don't want to see that happening. So when we do see instances where the volatility is a bit excessive and there's some issues with market functioning, then we will step in. And
so under what circumstances, Governor, might you intervene and prop up the currency?
Exactly.
I'm just going to bring in Bank Indonesia, for instance. It was forced to step in and intervene to support the currency, and given where the dot plot is right now, where the suggestion of only one cut, in fact even none, that could drive the dollar stronger and your currency weaker.
Yeah. As I was mentioning, we look basically at whether there are market movements that cause the exchange rate to be excessively volatile, and those movements don't seem to be underpinned by fundamentals. And when we start to see issues of market functioning, where the markets are too thin, the spreads get too wide, and it looks like there's dangers of snowballing effects, then we'll come in and intervene. But our preference obviously is not to do that and to let the markets function as
So for the BOT, fair to say it's either a cut or a hold. Hike is not an option? Is that kind of like what we're looking at?
Haslinda, in this world of great uncertainty where anything can happen, I wouldn't say that anything is completely off the table.
So even a hike is not off the table?
suppose there's a scenario where all of a sudden we get another, Russia-Ukraine type situation and commodity prices spike and it causes inflation to become entrenched and inflation expectations to become unanchored, then obviously I think, any kind of reasonable central bank would have to take some measures to address that. So, I'm reluctant to kind of commit, because, we will be guided by what happens. But the baseline view, as I pointed out, is, if we see, again, growth in inflation, and the other thing we keep a very close eye on is financial stability. Can't be underplayed in our context because we have such high household debt to GDP. Our baseline scenario is that things gradually coming back to our, the ranges that we'd like to see, and so, we feel that the current rate is appropriate for that.
Governor, you've been under a lot of pressure from the government to cut rates. In fact, the government has now suggested that perhaps you should revise up the inflation target, and some suggest perhaps that's a way to open up the option for you to cutting rates. I mean, what do you make of that suggestion from the government?
I can't speak to the motivation behind it because you'll have to ask the finance minister for that. But I can say that for us, from our standpoint, we feel that the current inflation target range of 1% to 3% is appropriate for the circumstances prevailing. And I think it's important to recognize it's worked pretty well for us. It's worked pretty well in terms of keeping inflation expectations anchored. If you look, for example, when we had the situation in Russia and Ukraine, headline inflation in Thailand spiked at close to 8%. It was like the highest in the region. But we also subsequently had very rapid disinflation, and it came back into our target within about 7 months, if I remember correctly, and then became even lower than that. But again, I think that shows the success of having this well-anchored inflation targeting regime, which kept inflation expectations anchored. So it's worked well. When we feel that a 1% to 3% range is sufficiently flexible to accommodate growth, particularly our potential growth, which is see it again ballpark about 3%. So we don't see that there's an immediate need to change that inflation target regime. That change, the inflation target is something that we agree and discuss with the Ministry of Finance. So it's something that is a joint decision, and we'll be doing that, having that discussion beginning in August and coming into September, October this year.
What are some potential ramifications, implications of raising that inflation target that may not have been considered by the government?
Well, one thing I think, Haslinda, is you raise the inflation target range. One, it increases the risk that inflation expectations become unanchored. If inflation expectations become unanchored, there's a danger that actual inflation starts to pick up. So we might see higher inflation. And the other thing also is once inflation expectations start to pick up, we will see bond yields pick up. So borrowing costs for the government, for the country as a whole, could also increase. So again, that's another reason why we feel that the 1% to 3% range, based upon all available data right now, seems to be an appropriate range. But again, this is something that we have to discuss with the Ministry of Finance.
The BOT independence has been in question. In fact, one of SETA's members have come out to say that perhaps the BOT's independence is in the way of economic growth. She went as far as to say that. I mean, what do you make of such comments from the government?
I think a couple of things. First, I think central bank independence isn't an end in itself, but it's an important means to an end, which is trying to ensure policy credibility and getting the kind of outcomes that we want to see, which is stable macro framework, low inflation and whatnot. And I think the proof is in the pudding. And if you look at the experience worldwide, I think it's quite clear that countries which have, again, that kind of independent and credible policy regime with central banks do a better job in terms of inflation outcomes and other outcomes, including financial stability, which again should not be overlooked. So I think the empirical and cross-country experience clearly supports that. That said, we see this issue of central bank independence being challenged everywhere. Well, not everywhere, but in many places.
In countries like Turkey, for instance?
But even in the developed countries, we see, I think, in the developed markets, the major developed markets. You can probably, I don't want to refer them necessarily by name, but issues about central bank independence being challenged. So I don't think it's unique by any stretch of the imagination to Thailand or to emerging markets, but it's something that we see happening around the world.
But the government has suggested that perhaps it should have its own man as the chairman of the BOT.
The process of nominating the chairmanship hasn't changed. The way it works is that the Ministry of Finance sets up a selection committee composed of 7 people. We nominate a candidate, the Ministry of Finance nominates a candidate, and then the committee chooses that person. That process is still intact.
So are you concerned that perhaps the government could eventually nominate its own person as the chairman of the BOT? And what implications that might have on the workings of the central bank?
Yeah. I think one thing, Haslinda, which is important to point out, is I think our governance framework at the Bank of Thailand is a fairly robust one, and perhaps different from other central banks. Just to be very clear and very specific on this, for example, our board, the chairman that we're talking about is the chairman of the Bank of Thailand board. But the way that we're set up is the Bank of Thailand board oversees administration issues about the Bank of Thailand, so things dealing with the budget, with people and all that kind of stuff, and reserve management. But the policy decisions, Monetary Policy Committee, for example, dealing with issues about the interest rate, just to cite one example, is separate from the main board. So the composition of the MPC is different from the composition of the main board, and so the chairman doesn't have any kind of direct
So as
say
we sit
over
here
that.
right now, Governor, you are confident of the independence of the BOT, regardless or not the government chooses the chairman of the central bank?
I think our track record speaks to that. I think our governance framework supports that. So yeah, at this point, barring any changes in the law, I think the framework that we operate under is a quite robust one. I mean, just to be clear, Hansel, I mean, you got the Bank of Thailand board, and then we have 3 key policy committees, which are all separate from the main board. So there's the Monetary Policy Committee, which has these 7 members. There's a Financial Institutions Policy Committee members, again, which is separate from the main board, and the Payment Systems Committee. So the key policy committees are separate from the main board. And I think that's a framework which I think is a healthy one, a robust one.
Governor, suffice to say, you've been a man under a lot of pressure from the government. What has been the biggest challenge for you in becoming the BOT governor? I know your term ends in September next year.
Yes.
What's been the biggest challenge for you in navigating all these challenges?
Oh, well, there are many. I guess in terms of if I had to think of a theme that I think it's not just me or here in Thailand, but I think we see this when I meet with my central bank governor colleagues from other central bank governors, is that the communication challenge is a very tough one, because a lot of things we have to do are not necessarily popular, but they're the right things, and so trying to explain that and communicate that to the broader public is a big challenge. I would say that's one thing that is tough. I mean, I think those old days, when you had this term like Fed speak, and back in the Alan Greenspan days, you could go out and say a couple of words like the Delphi at Oracle, and nobody would quite understand what he was talking about and get away with it. I mean, those days are gone. So I think, that communication challenge is a very tough one.
If offered, would you accept another term as BOT governor?
First, I can't be offered it because by law, I hit my retirement age. No, we can't actually apply for 2 terms, provided that before the second term starts, I don't hit my retirement age. But I hit my retirement age early next year, so I'm out of the running. So September, I am looking forward to retirement.
Governor, before I let you go, there's also the issue with high household debts, which is a huge concern in Thailand. How critical is the issue for you?
Yeah, I will say this, it's a very severe issue. If you look at the high level of public debt, over 90% of GDP, if you look at the composition of it, it's very challenging because a lot of it's unsecured stuff. It's credit cards and personal loans, so it's not like other countries where it's mortgages. So if asset prices rise, it helps out. So it's a trickier problem to solve. But in terms of the criticality, I would compare it to, if I had to use an analogy, I would say it's like a chronic disease rather than an acute one, meaning it's like diabetes rather than having a heart attack. So it's something that's likely to persist with us for a long time, be a big drag on us, and it'll be very difficult to resolve. But it's not something that's likely to lead to a crisis like a heart attack. Why? Because if you look, the financial system, particularly in terms of the banks, they're quite solid. Capital ratios are quite high. They're very well provisioned against these deterioration in credit quality in the households and whatnot. So it's not likely to translate into a banking crisis, which would be a heart attack type scenario. But there's no doubt that the borrowers, the debtors, are suffering. And so there's this big overhang of debt, which will weigh on consumption and weigh on growth, and has contributed to our slow recovery and slow growth. So from that standpoint, it will continue to be a drag. And because it's a household debt problem, it's very tough to solve. We went through, in 1997, a banking crisis and a debt crisis, but that was a wholesale problem. This is corporate debt, which is easier to deal with because it's like big, chunky borrowers. But this is retail. I mean, it's like,
How do you counter the problem? How do you intend to counter the problem while still maintaining growth?
Yeah, no easy solution. Short answer to your question about how do we handle it is, I would argue, having the right policy mix. And I put the emphasis on the word mix because, any one tool is not going to work, right? If you have just one tool like interest rate, it can't address at the same time domestic stability, external stability, and financial stability. So we need to complement it with other kinds of tools. So we use an integrated policy framework. So we want to use it in conjunction with other kinds of tools, including macroprudential measures. And for us in this context in Thailand, where it's this wholesale this retail household debt problem, debt restructuring is absolutely a critical element of it.
How much can be achieved before your term ends in September next year?
This is not a problem that's going to go away anytime soon. The thing that we want to do is try to make sure that the household debt gets back on a more reasonable trajectory. I mean, it was increasing rapidly before COVID. It kind of got this turbo boost during COVID, and it's starting to level out now. But we haven't seen enough of a slowdown in that household debt to GDP trajectory to make us feel comfortable. We need part of the reason that, another factor that we need to keep an eye on making our rate decisions, the MPC, is not just look at growth and inflation, but also look at financial stability.
Right. So at this point in time, you see this persisting for years to come?
We see household debt to GDP being higher than where we would like it to be, which the international norms say it should be about 80% for quite a few years to come.
All right, Governor, we thank you so much for your insights today. Thank you for joining us. Bank of Thailand Governor Sethaput Suthiwartnarueput there joining us here in Bangkok. Still to come, a big take looking into the use of nickel as a critical component of EV batteries and the deadly secret powering the success of this base metal. That's coming up next. Keep it here with us. This is Bloomberg. Welcome back, and let's get you back to markets. Asia tracking gains in the U.S. Avril Hong on top of developments in Singapore. Avril.
Yeah, so we're seeing China markets about to go off to the lunch break, but today it's been a fairly flat picture, even though it's a slight rebound from the flat close a day ago. Amid those concerns about the Chinese economic recovery, they're really centered on the property sector. We're seeing that actually boosting these expectations that we're going to get cuts from the central bank there, and that is helping to further fuel that rally in Chinese bonds. But that is something that could put pressure on the currency. We're seeing offshore yuan hovering near the 7272 level. Now flip the board, because even as we talk about potential rate cuts in China, for Japan, it is about potential rate hikes. And based on the comments from the BOJ Governor Ueda, that seems to still be on the table at his meeting next month, even though there was some skepticism that it could come at the same time that the Bank of Japan is going to reduce bond purchases. So pressure on Japanese government bonds. The stocks there are still doing well. They're tracking their Wall Street counterparts. Still seeing some weakness on the yen, although it's recovering some lost ground now, moving below the 157.7 level. Now, the other currency that we're keeping a really close watch on is the Thai baht. Last week, we saw the central bank there keeping rates unchanged, as you know, has defying the pressure from the government to cut rates. And I think that helped to provide some support for the Thai baht, but it has been weakening amid the political uncertainty in the country. We see how former Premier Thaksin, as well as the current Premier, Srettha Thavisin, both in the midst of legal trouble that could pose fresh turmoil for the political situation in the country. And this is also coming against the backdrop of a resilient dollar. So a lot at stake here when we look at the currency as well, Has.
That's right. Political fragility in Bangkok, here in Thailand in particular. Of course, that currency down 7% year to date, among the worst performers among Asian currencies versus the USD. Well, let's keep it here to Thailand. I just spoke to the Bank of Thailand governor about the growth of the economy and price pressures. Take a listen.
In terms of our forecasts for this year, we see growth coming in at about 2.6, ramping up to 3% next year. And inflation this year is still on average a bit below target, but gradually going back into our target actually, it'll come back into target within the second half of the year.
Well, for more, let's bring in Asia Pac market editor Margo Tawi. Margo, it does seem like he's quite upbeat about the potential later in the year.
Well, it's quite possible that things could improve later in the year, but a lot depends on what happens externally. China's economic conditions, for example, it's a big trade partner, and also what happens domestically, particularly on the political front, as you've mentioned. There's a lot going on there, and any further disruptions, any further instability could further frighten foreign investors who've already pulled out a lot of money this year.
Yeah, and to your point, Margo, we have Thai equity markets and the baht performing so badly. I mean, you got to wonder, whether a turnaround is in sight.
Yeah, it's quite a difficult scenario. You have a country that hasn't been getting sufficient government spending due to political issues. The last government wasn't formed for some time because of machinations going on in the back rooms. That meant that the budget disbursement was delayed. You haven't had the tourism arrivals that were hoped for because Chinese haven't returned. Well, they have come back, but not in the numbers that were expected. And exports are down. Demand is down generally. So an economy that's dependent on tourism and exports, those are two critical components that are lacking.
What else is needed, Margo, to revive investors' interest in Thailand? Is that spat between the BOT and the government impacting sentiment in any way at all?
Well, yes, it is. It is. It's definitely impacting sentiment. But more broadly, you've got to look at the basis of the economy. You have a super ageing society. You have a lack of superannuation savings. You have industries that haven't become smart. The industry is very old industry. You haven't seen any move into upstream capabilities, chips, EV, and so forth. Those sorts of things are lacking. So structurally, there's a lot of issues as well that are deterring investors who see that they can get a better bang for the buck somewhere else.
Margo, we talk about political fragility. We saw the indictment of Thaksin Shinawatra on a royal defamation case today. A court also weighing a petition to disqualify Prime Minister. What are the implications to markets, to the economy as well?
Well, again, this could lead to more disruption in the government sector, in disbursements of money. If you have the Prime Minister removed, then you need to have a new Prime Minister put in place. The last time this happened, there was a whole lot of backroom wrangling. The military-appointed senators refused to endorse the politically mandated Prime Minister, who is now in the opposition. So where do we go from here? Who do you put in? Who is an acceptable Prime Minister? At the same time, these two court cases. There's also another court case that's being considered by the Constitutional Court as to whether the appointment of a new round of senators is acceptable. And if it decides to proceed with that, the old Senate will stay in place and will still have the same veto rights over a Prime Minister.
You also do wonder how the Thais at large would react to those court cases. Asia Markets editor Margaret Hoey, thank you so much for that. Now let's stay with Thailand. Thailand's Senate is set to approve a same-sex marriage bill today, bringing it close to becoming the first Southeast Asian country to guarantee equal rights for gay and lesbian couples. If passed, the bill will be sent to the cabinet for approval and submitted for royal endorsement, which is seen as a formality. The legislation will be effective 120 days after it's published in the Royal Gazette. And Indonesia has become a global giant in producing nickel, a critical component of the batteries that power electric cars. But there is a dirty and sometimes deadly secret behind this success story. Bloomberg has been investigating for today's big take. For more, let's bring in Matthew Campbell, for our Asia editor for Business Week, who worked on this. He joins us right now. Matt, tell us more about this investigation into the mines.
For over a year now, we have been looking into the Indonesian nickel industry, which plays a critical role in the electric vehicle supply chain. And what we found is that it is a dirty and deadly industry that is causing, sadly, a large number of fatalities and has connections to all, virtually, of the largest electric vehicle manufacturers in the world who do depend on this commodity for their production.
Talk to us about these safety, health, and environmental risks.
Well, nickel obviously has to be mined, and Indonesia has the world's largest nickel reserves. It also has to be processed. And the processing is something that happens largely onshore within Indonesia in these enormous industrial facilities where there are a very large number of accidents. There was an explosion in December that killed 21 workers, which is just astonishing to me. The other factor, of course, and it's a big one, is the environmental damage. These facilities are powered notably by coal, which you can imagine is a bit of a problem.
So, Matt, what's the significance of Indonesia's nickel supply?
Indonesia has the world's largest nickel reserves by far. If we are going to get a major transition globally into electric vehicles, it is very likely that Indonesian nickel is going to have to play a significant role. What we've heard from activists, from environmentalists, from people who look at ESG issues, however, is those reserves need to be mined and processed and generally exploited in a more responsible way from an environmental and safety perspective.
Matt, thank you so much for that. Matthew Campbell, Asia editor for Business Week, with that piece there. Subscribers, of course, can read more on this story on the terminal. NI Big Take is your function, or listen to our Big Take Asia podcast on iHeartRadio, Apple Podcasts, as well as Spotify. Now we have some lines to tell you about. Premier Lee is in Australia, talks about widespread desire for better Australia-China ties on the back of that trip. Also, China development is an opportunity, not a threat. Those lines coming from Lee, who's visiting Australia right now. Well, still to come, we'll be speaking to Kotak Mahindra Asset Management about the outlook for India's stock market, as well as the drivers post-election. India Focus is next. Keep it here with us. This is Bloomberg. welcome back to Bloomberg Markets Asia. You're watching India Focus, and of course we're counting down to the India Open. Just moments now when you can see the benchmarks all in positive territory, pretty much in line with the rest of the region. Remember, we had the S&P off to new record highs overnight. There's a lot of optimism that those gains are sustainable. Of course, India has been a darling ever since those election results as well. That's driven those stocks and benchmarks higher. Now let's see where the opportunities are for India markets next with our next guest. Shibani Kurian is head of active research at Kotak Mahindra Asset Management. Shibani, good to have you with us. We talk about elevated valuations, but they say in India they're justified.
Hi, good morning. A pleasure to be here. So you're right. There's a lot of debate about valuations of India, especially in context of the rest of the emerging market pack. But to some extent, when you look at India's valuation, you have to look at it in context of the earnings growth. So for FY24, if you look at the Nifty index, which is the large cap index, the index delivered about 24% EPS growth versus an expectation of about 20% growth at the beginning of the year. For the next 2 years, which is FY25 and 26, the expectation is of mid-teens earnings growth. So the earnings trajectory remains strong. Macro parameters are fairly stable. And most importantly, the domestic flows continue to remain strong. In this context, when you look at valuations, at a large cap Nifty level, we believe that valuations are reasonable, just a few percentage points above long-term average history in terms of one-year forward PE. However, when you look at mid and small caps, there are pockets of overvaluation where one needs to be careful. The mid-cap and small-cap indices are trading at about 27 to 30% premium to their long-term average history. And therefore, those are pockets where we would be slightly careful in terms of valuations. But when you look at the Nifty per se, which is the large-cap index, valuations appear reasonable.
Shibani, valuations are not just high, they're among the highest in the world. You got to wonder how much more upside from here, even when you talk about corporate profitability going forward.
Absolutely. So as I was mentioning, there are pockets of overvaluation. So when you look at stocks, for instance, where the entire free float is limited, but those stocks which have moved up considerably over the last couple of years, not justified by fundamentals, those are pockets which we would avoid. Even within the overall market construct, some of the small and micro caps where valuations have moved up considerably vis-a-vis the large caps, as well as versus their own history, those are pockets where we would be concerned. However, when you look at just the large cap Nifty index, the Nifty is trading only at a 4% premium to its long-term history over the last 10 to 15 years in terms of multiples. When you look at India's growth relative to the emerging market pack, the growth both in terms of macro as well as corporate earnings remains fairly comfortable. So when you look at risk reward, what we have been clearly saying is that in terms of large caps, risk reward still seems to be in your favor, while one should be cautious where mid and small caps are concerned. And this entire debate about valuation premium of India vis-a-vis the emerging market pack has been going on for a while. And that's something that we believe is here to stay simply because of the growth differential. And now that the elections are behind us, the key focus will be in terms of policy continuity. And in that context, the union budget, which will possibly be there sometime in the month of July, is going to set the tone going forward as far as policy is concerned.
Right. You talk about risk reward, Shibani, in terms of sectors, what would they be, especially on the back of expectations of policy continuity? Would that be infrastructure, manufacturing, the key projects for Prime Minister Modi?
Absolutely. So if you look at the policy initiatives that have been taken by the government over the last 2 terms, the focus has been in terms of investment-led growth, which they believe in turn will lead to employment generation and overall growth. I think that policy structure continues with focus on fiscal consolidation. However, one also has to realize that when you look at consumption, especially private consumption in India, that has been growing below trend, specifically the mass consumption or the bottom of the pyramid. We now believe that the government does have room on the revenue side, given that they have received extra dividend from the RBI as well as buoyant tax collections, to focus a little bit in terms of improving the consumption structure, especially at the bottom of the pyramid. So that's going to be one area to watch out for. Now, in terms of valuations, we believe that there are a few sectors apart from the investment infrastructure segment that we spoke about, where valuations are reasonable. One is in terms of the large private banks, where fundamentals and valuations seem to be at differing ends, where fundamentals have improved but valuations are below long-term averages. The consumption space, specifically the staples part, where again the growth has been tepid and valuations are below long-term averages. And the third area to watch out for would be the large cap tech space, where again you have valuation comfort. So overall, the structural story in terms of investment, infrastructure and manufacturing remains intact, where domestic facing sectors such as these continue to deliver on earnings growth. From a valuation perspective, banks, consumers and IT provide support.
Given the election results, some say that perhaps you can expect more populist and rural policies. How do you play that? Where do you put your money?
So I think given the election results and now that the allocation of ministries are behind us, we believe that the government policy is not likely to be populist. However, you're right that there are some signs of improvement on the rural side, and we do expect to see some policy support to push up consumption at the bottom of the pyramid. On the rural space, I think sectors such as consumer staples, for instance, the two-wheeler segment, which derives demand from the rural economy, some of the rural financiers or lenders, which again derive considerable amount of their growth from the rural segment. These are sectors to watch out for. The rural real wage growth has been fairly stagnant over the last decade, in fact. Our belief is that now there are signs of improvement at the margin. The monsoons are going to be a key driver in terms of the food production, especially the summer crop. That's going to be one key factor to watch out for. Apart from, of course, the policy support, which could come in at the margin from the union budget. Overall, we believe that the fiscal consolidation story remains intact, but you will see some possible support to push up consumption at the bottom of the pyramid.
We have seen massive domestic flows. Will that persist, you think?
So I think that's been the great story for India. If you look at flows and if you look back, say, 5 years ago, Indian markets were considerably influenced by what was happening in terms of foreign institutional inflows. Over the last 3-4 years, FII flows have been extremely erratic, while the domestic flows continue to remain strong. I think the domestic flows, especially in terms of the systematic investment plans where money comes into mutual funds such as us on a monthly basis, has been rising, and that's sticky money. If you look at today in the entire financial savings pie, equity still forms a fairly small portion, and therefore there is a long runway for growth where retail participation goes in equity markets, either directly or through mutual funds.
We know that millions and millions of Indians are buying stocks directly right now. I'm just wondering whether that might prompt some tax changes. We know there have been some murmurings of that possibly happening. Is it something you're expecting?
There we'll have to just wait and watch. Of course, this has been debated long in terms of the differential on taxation, especially where capital gains tax for equities are concerned. However, given the fact that, as we were earlier discussing, participation of retail in equity markets is still very nascent in India, changes in tax structure needs to be thought out very carefully. Unlike the developed markets, which are more, have larger participation of their retail investors into the overall equity markets, the same is not true. We need capital for companies to grow and develop and to expand and do capex, and therefore equity markets need to have that support in terms of getting further participation. I think that's something that we will have to wait and watch for. As I said, the budget will possibly be announced sometime in the end of July. That's going to be one key factor that the entire market will wait and watch for.
Is the extreme euphoria a risk factor in the market, you think, Shibani?
In pockets, yes, I would agree with you. So, when we were looking at stocks in different pockets, some of the small caps and micro caps, where the earnings expectations are far ahead of the curve, that's where we would be somewhat cautious. If you look at the multiple re-rating that has happened between large, mid and small and micro, especially for small and micro cap, the movement has been more led by multiples rather than just earnings growth, and therefore the expectations of earnings are much higher in that segment. So therefore we would be cautious to some extent there. In some pockets where the free float is low and therefore liquidity being low has been a driving factor of stock prices ahead of their fundamentals, that's also another pocket where we would be very, very careful. Overall, in our investment philosophy and the framework, we continue to look at companies and sectors where valuations are reasonable, backed by fundamentals. Growth at a reasonable price has been our investment philosophy, and that's something that we continue with. We stay away from companies where valuations are extremely rich.
Back to fundamentals. Shibani, thank you so much for your time today. Shibani Kurian, Head of Equity Research at Kotak Mahindra Asset Management. India's been trading for maybe just under 10 minutes. Let's do a check on how they're doing right now in positive territory, adding to those gains that we've seen in recent weeks since the election results. There you have it, the benchmarks in the positive at this point in time. Tracking gains in the rest of Asia as well. Plenty more ahead. Do keep it here with us. This is Bloomberg. All right, welcome back. Here are some top stories we are following. Russian President Vladimir Putin will visit North Korea and Vietnam this week. The Kremlin says Putin will travel to North Korea Tuesday and Wednesday and go on to Vietnam from there. North Korea has been a steadfast supporter of Putin's war on Ukraine. Analysts expect both countries to deepen their military cooperation during the visit. Canada's government is buying a stockpile of rare earth materials mined in its Northwest Territories to prevent them going to a Chinese buyer. Australian-owned miner Vital Metals will sell the stockpile to the Saskatchewan Research Council for a little over $2 million. The intervention is part of Canada's push to block Chinese farms from delving further into its critical mineral sector. And Hong Kong will allow market trading during typhoons and major storms from late September. The decision will end a decades-old practice that left the city an outlier among financial hubs. Chief Executive John Lee says the transition period provides ample time for market players to prepare. Hong Kong is typically hit by 5 to 8 typhoons each year, but not all reach the high alert levels that do trigger those shutdowns. And we are counting down to the RBA rate decision coming up in a little over 30 minutes. The Central Bank is expected to hold its key rate at a 12-year high. Keep it here with us. This is Bloomberg.
Right, welcome to the show. It's just past 12 noon in Hong Kong. Welcome to Bloomberg Markets Asia. I'm David Ingles. Let's get to your top stories today. Stocks across the Asia Pacific on the up after a surge in tech drives Wall Street to its 30th record high of the year. You have chip makers in the region leading the advance among the biggest gainers this Tuesday. Right, set this hour, the RBA on deck, and the central bank is set to keep bonds under pressure amid perhaps a hawkish hold expected, of course, with the sticky inflation situation there down under. Plus, staying on central banks here, we hear exclusively from the Bank of Thailand governor resisting political pressure for a rate cut and telling us the central bank must remain independent. Right, more of that interview in a moment here. In the meantime, though, a quick check of markets as we enter, of course, the mid part of the session. And, of course, as Europe starts to wake up, Avril Hong is joining us right now to get us up to speed. Avril.
Yeah, I mean, it's an interesting morning session that we've been seeing. The Hang Seng actually entered the lunch break with some of those declines, erasing earlier gains. In the event, we thought we saw a bit of a rebound from the flat close of yesterday, despite those concerns about the Chinese economic recovery and the real estate sector. The Japanese benchmark is managing those gains. Today, it's really about the tech sector, tracking Wall Street's performance. think about how the mega caps have been faring. But aside from the stocks, let's take a look at what we're seeing in the FX space, because dollar China is in focus amid those economic recovery concerns. And our MLive colleagues have been taking us back to the US-China trade war. I mean, this time around, we're seeing those trade tensions on multiple fronts, right, with the US, with Europe, and the currency was really bearing the brunt of the selling amid the height of the US-China trade spat. We could see more of the same this time around. The key difference to watch out for, I guess, is the real effective exchange rate, which seems to show that now the Chinese currency is overvalued versus back then when it was seen as undervalued and could therefore afford to depreciate. That's among the things that we're keeping an eye on. Yen also in focus, getting a boost from Ueda's comments that put those rate hikes next month on the table. But we are really keeping it watched really closely on the Aussie dollar ahead of that central bank decision today. It is potentially going to talk about that hawkishness given how sticky inflation has been. And let's also take a look at how this is playing out in bonds, because bonds have been bracing for, I think, those hawkish signals from the RBA, tracking, of course, what we saw on Monday in US Treasuries, but the extent in which we will see it react, our colleagues at MLive have again been talking about how it might not be that bad. Post-RBA decision, if you take a look at what we saw in the past 9 decisions, the majority of the time, bonds on the short end of things actually climbed between the RBA decision and the end of trade. So that's something to keep an eye on, David.
Minutes from now, that specific window that Avril just outlined for us. As one of the stories Avril was also covering also this morning was, of course, these developments over in Thailand, where the ex-Prime Minister Thaksin was formally charged in his royal insult case. And we now understand, based on what we're getting from Thai media, is that he has been granted bail. Okay, more on that in a moment. Certainly more details on that, of course, to follow shortly. Let's stay in Thailand. And, of course, if you missed it, my co-anchor, Haslinda Amin, in the last hour spoke exclusively with the central bank governor about the growth in the economy and the price pressures there. The governor says there's no immediate need to change its inflation target. Plus, of course, they also covered this drama between the central bank and the government and the pressure that the government has put the central bank under and why they've actually held out so far. Have a look.
We see growth and inflation gradually moving back to their long-term target levels. So growth, for example, we see gradually moving back to about 3%, which is where we see our long-term growth potential at, and inflation gradually moving back to our 1 to 3% inflation target range. In terms of our forecasts for this year, we see growth coming in at about 2.6, ramping up to 3% next year, and inflation this year is still on average a bit below target, but gradually going back into our target actually it'll come back into target within the second half of the year.
Some are optimistic, though. Some say that perhaps you will have issues getting to 2.6% this year, 3% next year, because output remains really, really weak, way below pre-pandemic levels. And when you take a look at inflation, for instance, core inflation in particular, still lackluster, 0.4% year on year. That is not a good story.
Yeah. On the growth front, I have to say that we didn't change our forecast from this MPC compared to the last MPC. There's a headline GDP forecast that's the same, 2.6%. But in terms of confidence about the numbers and seeing that the outturn came out close to what we had initially forecast, I think we have greater confidence in that number. Confidence not in terms of like there's more upside to the number, but confidence that number is likely to materialize and the downside isn't there. Why? A couple of reasons. First off, the Q1 outturn came in actually stronger than we'd expected. I know the headline, Q1 year-on-year number didn't look good, 1.5%. Didn't look good from an optics standpoint. But you look at it in terms of quarter-on-quarter movement from fourth quarter. In terms of our estimates of the seasonally adjusted quarter-on-quarter number, it was a 1.5% quarter-on-quarter change, which is about twice the average level that we've seen in terms of quarter-on-quarter movement. So a pretty good pickup. And the other thing that we were concerned about was in terms of the second quarter, how it looks going forward. And on that, again, One thing that was a big risk was about how likely are we to see government disbursements coming out, and on that I think the news has been fairly positive. The initial numbers for second quarter also look fairly positive, so that gave us quite a bit of confidence again that trajectory that we saw was intact. Are there risks? Yes. Biggest risk I would flag would not be so much actually on the domestic front. We think the domestic numbers will be okay, but we do have some concerns, particularly on the export front.
Let's talk monetary policy. We know that you're not guided, you've said time and time again, you're not quite guided by the Fed, although it's hard not to be guided by the Fed these days. You stood pat for 4 consecutive meetings, unlikely to move, perhaps move once, some say. What's changed? Has anything changed to drive that view going forward?
What's changed, as I mentioned, the forecast and everything we kept that the same. In terms of the outlook, the outturn was, particularly for fourth quarter, a bit weaker. So kind of broad contours are there, but things are a bit slower getting back to where we had anticipated. So that was one change. But as I said, in terms of the most recent MPC meeting, we saw that we had greater confidence in terms of the numbers that are coming out. With regards to the Fed, we look first and foremost in our flexible inflation targeting framework at domestic factors, growth, inflation, financial stability. But we are a very small, very open economy, so the exchange rate matters a lot for us, and capital flows matter a lot for us. So we obviously have to keep an eye on what's going on with the Fed, but an eye. We're not led by that.
The thing is, the Fed dot plot now suggests only one cut, possibly
cut.
none.
Yeah.
That means there's very little wiggle room for you to move this year. Is that a fair assessment?
There's no mechanical relationship between what the Fed does and what we do. So it's not like we have this kind of...
Not unless your currency is under a lot of pressure, which it is currently right now down 7% year to date.
Yeah, second only to Japan, I think, as is often mentioned in the news articles written about Thailand. Yeah, there's no doubt that the currency, I think, has been depreciating. Volatility has been high. But we have no preset level for the exchange rate. And as I said, but we obviously have to pay close attention to it because the exchange rate matters a lot for a small, open economy like us. And the thing that we pay attention to more than the level are the movements. So we don't want to see movements that are excessively volatile. We don't want to see movements that are not driven by fundamentals. But if you look at what's been happening, a fair bit can be explained by fundamentals. A lot of it, obviously, by what's happening with global factor in terms of the Fed, but also, as you point out, that our growth outturn and whatnot has been weaker than other places. So that weakness is underpinned by some fundamentals. That said, I think the picture in terms of capital outflows, for example, is an improving one. Last year we saw outflows of 9.9 billion. This year, ballpark year to date, it's about 4. And you look at first quarter, it was like 2.8. Second quarter is about 1.2, so it's slowing down. So I think there's support for the currency going forward. The current account surplus last year, we expect it to basically double from what it was last year. So that'll also add support to the currency. And the other thing, Haslinda, is that in terms of our tolerance, I guess, the best way to put it, for exchange rate movements, is higher than it used to be, say back in, the bad old days of 1997, because, our external vulnerability is much, much lower. We don't have much external debt. Our reserves are higher. Current accounts and surplus.
So you're comfortable with where the body is right now? It's down 7% year to date among the worst currencies in Asia. You're comfortable with the movement so far?
When you say comfortable, I don't want us to pinpoint to a level again and say that we're fixated on any kind of level and that we're comfortable with this level.
But you're not too concerned about the movements in the currency?
When we look at the movements thus far, we see that they have been underpinned by fundamentals. I mean, there are reasons why they move the way they do. Sometimes the movement's been too volatile and we see some issues with market functioning. Because one thing is that the markets, not just in Thailand, but in a lot of emerging market Asian countries, is that the FX markets are quite thin. So when there are these big movements, there's the danger that sometimes things snowball, and so we don't want to see that happening. So when we do see instances where the volatility is a bit excessive, and there's some issues with market functioning, then we will step in.
There we go, and that was the Bank of Thailand governor speaking with us earlier on outlining effectively where they think policy might be over the next few months or so. Right, what's it been like investing in fixed income this year? Well, we have a fairly simple graphic for you. I think you have the global aggregate index. You have rates, you have high yield, and then you have sort of your treasury board. Suffice to say, this is over the last 3 months or so. If you take this back year to date, though, I think you've done better on credit than you have on rates. Does this continue? What does the macro look like? Have we really entered an easing cycle in earnest? Do we need the Fed to do so to sort of conclude that? Let's bring in Adam Whiteley here on set with us, Head of Global Credit at Insight Investment at BNY Investments. It's nice to see you. How are you?
I'm good, thank you, and pleased to be in the region.
Yeah, what do we start there? Credit's done slightly better than rates. Can that continue?
We can.
Okay.
We think that you should be constructive on credit for two reasons. One, the cycle, and two, the level of income available. As a backdrop, we've got growth that looks like it's stabilized, arguably broadening out and improving. You've got inflation coming down, and you've got monetary policy, which is more likely easier in the months to come than tighter. That creates a supportive backdrop for risk assets, credit being one of them. And then on the second point, the income available today is meaning that there is an asset allocation shift where investors are closing out underweights to fixed income, trying to lock in these high levels of yield.
The notion that cash is a better alternative, what's the pushback?
Reinvestment risk.
Okay.
And what comes next.
Okay. But we said that, though, 6 months ago, and yet here we are.
And that's been the real dilemma in the expectations are still there for cuts, but they keep getting pushed out.
Okay.
And the pace of those cuts has been shallowing too. So, cash today attractive, undoubtedly, but looking forward, will you have that level available? Probably not. Do you have any interest rate duration? No, you don't. So in an environment of lower rates, lower policy rates, lower yields, you will get a tailwind from having some structural exposure to interest rate sensitivity.
Right. Let's say the next 30 basis point move on Treasuries, the 10-year, let's do it. Up or down? Likely.
Likely down.
Okay.
We think that there's scope for yields to maybe rally to closer to 4% of the 10-year over the next 12 months. Where we have a little bit of a difference of opinion with the Fed and maybe the market is that the so-called neutral rate's a bit higher than previously thought.
Yeah.
And that's got two implications. The first of which is that policy is probably less tight today than people anticipate. And maybe that talks to this inflation story being stickier. But also it means that the end point for the rate cutting cycle is probably higher than previously thought as well.
Is inflation still a problem? Or how big of a problem is inflation? Let me rephrase that way.
That's the real key driver of markets at the moment. In the inflation picture, the trend's clear, but it's a bumpy path. You look back at the last few data prints, we're surprising on the upside, we're surprising on the downside. Central bankers across the globe have got one cycle, it's a global one, but you've got a bumpy path and different speeds at which this inflation picture is improving.
So if I'm a treasurer, for example, or a central banker at that, right, I'm looking at this, so am I happy with rates at this point? What does it mean for supply? And what does it mean, say, for central bank policy rates moving forward? Everyone's trying to second-guess themselves in some sense.
Yeah, so on the supply picture, both within the government space and within the credit space, it's going to be healthy. So actually, fiscal policy still remains quite loose, probably looser than you would think, given what central bankers are trying to achieve.
Too loose?
Arguably too loose.
Yeah.
It's strange to think that if you've got monetary policy that's tight, that you've got fiscal policy that's easy. And there's certainly some concern around what elections may mean for fiscal policy in the outlook. And on the corporate side, you've got CFOs and treasurers that are happy to pay the market rate, but they don't want to lock it in for too long. So we've seen a shortening in the maturities that people are borrowing for.
Where do you see spreads end of the year? So I think on investment grade, I think we're below 100 basis points, I'm not mistaken. On high yield, I think we're approaching 300 basis points. Like, do we tighten even further? How much too?
Yeah, so tighter in both, probably more so relatively speaking in investment grade. The way we see the world, there's still a lot of uncertainty in an environment of a higher cost of capital and pressure on growth and earnings. That's going to hurt a leveraged capital like high yield more so. But undoubtedly, the sticker that's available for high yield with an 8% plus yield, that appeals to investors. That'll keep getting bought.
Okay, it's opportune to have you here in the region because Europe's been eventful over the weekend. What do you make of what's happening in France? Do you sit that out until we figure out, get more certainty on that? Or do I take advantage of the blowout in spreads that we had last week?
Well, we knew starting the year that half the world's population was going to vote. We've now got an incremental set of population that's voting, and that really is a surprise. And markets don't like uncertainty. Yeah. It's come out of blue when everyone was expecting a period of low volatility, and that really has unsettled fixed income markets in Europe. And that's the price action that you've seen. French borrowing costs have gone up, but it's not just France, it's the other European countries outside of Germany too. What we really need is some clarity. So we've got, certainly in terms of polling intentions, the far right look like they do better in France. And in their previous manifesto, they were talking about policies that would be more fiscally expansive. And people are worried about that in the current climate where you've got a high cost of capital, and that puts pressure on your debt to GDP dynamics. So more clarity needed before we step in. But we suspect that if you look at, for example, the Italian picture, once the more extreme ends of the political spectrum get into power, they become a little bit more centrist in their policies, and it's maybe not as scary as you might think.
Yeah, I was about to say, people tend to get more moderate once they're sat down in the office and they're faced with a sort of bureaucracy of getting things done. But would that be putting upward pressure still, you feel, on French yields, for example? Or, you know, are we near a bottom is what I'm trying to get to here, too.
Yeah, I mean, you've still got a week or two until the first round of the elections. You've certainly priced quite a bit in already. And I think the way to probably think about it is this could be a rating downgrade story, in the fiscal pressure will ultimately manifest in lower credit ratings, and that can be priced by looking at other countries within Europe. There's also the ECB's policy tools in the background. Some of that is complicated by an excessive deficit procedure and not having complete clarity on what that may mean for their ability to, if they wanted to, implement some of those policy tools. But we're not seeing this as one of the more scary Frexit scenarios that you would have talked about in years gone by.
Right. 10 seconds or so. Boring. UK elections coming up. Anything there? Yes or no?
No.
Boring?
No.
Perfect. Thank you. Great to see you. Let's do this again soon.
Thank you.
Adam Whiteley there, Head of Global Credit at Insight Investment, BNY Investments. Right, coming up, we're talking about TSMC. That stock is bids. Last we checked, over 2%. A couple of banks have upgraded their price targets on those stocks. More on that story in a moment. This is Bloomberg. Right, shares of TSMC, as you can see, doing quite well today. We have a couple of brokers and banks coming out and revising their price targets on the stock. Citi and also Morgan Stanley. Let's bring in our Asia Equities reporter, Charlotte Yang, is with us here to tell us why the outlook is slightly brighter, of course, for the company that's done very, very well, I should note.
Yes, it's like already gained 60% this year, now trading at a record high. But still, we have more bullish notes coming from Morgan Stanley and Citigroup today. So the reason is slightly different. Both of them have raised the price targets for around 10%. So for Morgan Stanley, it's about this, stronger demand coming from Apple's intelligence, specifically with cloud and edge AI. But for Citigroup, they're seeing a stronger earnings driven by battery utilization rate recovery, as well as those stronger demand for the advanced node. And also, they expect TSMC to raise its capex outlook for this year to 30 to 32 billion range. Earlier, it was 28 to 32 billion range.
Yeah. Okay. So Citi raised it by 10%, or was Morgan Stanley by 10%?
Citi was 10%. I think Morgan Stanley. Citi was 12%. Morgan Stanley was 10%.
There we go. There we go. Another stock we're tracking there is Honhai.
Yes.
To hit 200. Why is that important?
So I think a symbolic moment for Honhai, also known as Foxconn, who makes iPhones. And I think it's more probably for its founder, Terry Gou, because Terry said back in 2016 that he would not retire until the stock reached that level. But after those, a few years, it has always been very struggling because investors just not that excited about an Apple Play story. But this year, the AI story is coming back. So the AI service is exciting everybody.
And might Apple also come back as well? Yeah, there we go. Could he retire, though, at this point? Is the question. That's for another conversation. Charlotte Yang, our Asia Equities reporter. Right, plenty more ahead here on Bloomberg Markets Asia. Keep it here. You're watching Bloomberg. Here are some stories that we're following around the world. Russian President Vladimir Putin will visit North Korea and Vietnam this week. Now, the Kremlin says Putin will travel to North Korea Tuesday and then Wednesday and then go to Vietnam from there. North Korea has been a steadfast supporter of Putin's war on Ukraine. Analysts expect both countries to deepen their military cooperation during this upcoming visit. Now, Canada's government is buying a stockpile of rare earth materials mined in the Northwest Territories to prevent them from going to a Chinese buyer. Australian-owned miner Vital Metals, will sell the stockpile to Saskatchewan Research Council for a little over $2 million. Now, this intervention is part of Canada's push to block Chinese firms from delving further into its critical minerals sector. good news or bad news in Hong Kong, depending, of course, on where you are in this conversation. Hong Kong will now be allowing market trading during typhoons and major storms from late September. Now, the decision will end a decades-old practice that left the city as an outlier among financial hubs. The chief executive, John Lee, says the transition period provides ample time for market players to prepare. Now, Hong Kong, as a background, is typically hit by 5 to 8 typhoons each year, but not all actually reach that threshold or high alert that then trigger some of these shutdowns. September 23, mark your dates. There we go. Okay, very briefly, a look at the bond markets in China with yields pushing lower, as you can see on your screens. In particular, the reason this is relevant is, when the 10-year yield, for example, that's a fourth straight day. A big drop yesterday. The short end of this yield has really just not been able to find a floor. It's really in the longer end where there's this tussle between where you are with the economy and guidance coming through from officials that if inflation does come back, that's going to be a problem if you're long these bonds, right? And particularly if you're sitting on them on your balance sheets. Very, very quickly, we are counting down, of course, to the RBA rate decision. That's going to be in a couple of minutes from now, in about over 3 minutes from now. So the short of it is the central bank is expected to do absolutely nothing. More on that breaking news story in a moment. Stay tuned for that. This is Bloomberg. Welcome back, and you're just in time here. RBA decision is out, unchanged on the cash rates, 4.35% as expected by virtually all economists out there. They've left rates unchanged. The board is also not ruling anything in or out, which might suggest they're open to a broader sort of set of scenarios than what would otherwise be the case if you were making the assumption that the RBA was set to enter definitely an easing cycle at some point. On that very point, inflation does remain above target. It's proving persistent. They will be relying on the data and assessments to gauge that risk. They need to be confident inflation is moving sustainably to target. We've heard that before. Here's something new. The pace of inflation decline has slowed in the most recent set of numbers, which I guess underscores them leaving the door open on both sides of the table. We're getting a little bit of weakness coming through in the Aussie dollar as we speak, perhaps even more so as I continue to speak. Let's get instant analysis right now from Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. Shane, a pleasure to have you on the show. Your initial take, was this the right decision?
Look, to be honest with you, I'd prefer lower interest rates. I think we all know that monetary policy impacts with a lag. We're seeing significant flow-through of the past rate hikes still going through, and that will lead to slower growth going forward and possibly an overshoot on the inflation target on the downside. But I can understand why the Reserve Bank left rates on hold. I think raising rates would have been a big mistake. But the key message from the Reserve Bank statement is that they're still fairly neutral with a little bit of a tightening bias in there. That commentary at the end of the statement about not ruling anything in or out is still there. But the overall commentary is still a little bit more hawkish than dovish, which suggests if anything, they're more likely to hike than cut in the short term. But I do think as we get to the end of the year, they'll have more confidence inflation is coming down into target, and that will enable a cut, as we're starting to see in other central banks.
Shane, on that hawkish tone, and I can sense from your tone that you're more on the dovish side, but from their point of view, it sounds like they're trying to also sound fairly hawkish. Do you think they need to be? Do you think they need to sound hawkish is what I'm trying to get to here?
Possibly not as much as they are. I think the reality is the RBA has done enough compared to other countries. Australian households for the mortgage have seen a far bigger rise in the actual mortgage rates they're paying than virtually any other major industrialised country, and that reflects the high reliance on variable rates in Australia and very short-dated fixed rates. So I don't think they need to be as hawkish as they are, but by the same token, I can understand it. We get to see those inflation numbers come down back into target, and you can argue that inflation in Australia at 3.6% on the most recent number is still well above where it is in countries like Canada. That said, I think it is worth noting that Australian inflation, Australian interest rates lagged on the way up. We took longer to come out of the pandemic fully than other countries did, and therefore it's understandable we're lagging on the way down. So I don't think there's anything different about Australia which is causing the stickiness in inflation here. I think it's just normal lags in the system. But I can sort of understand why they want to sound tough. The jawboning does have an impact. It will keep people on their toes. People will still be a little bit concerned that they may get another hike, so that will stop a big increase in spending in the near term. So I can understand why they're doing it, but I don't think they need to be as hawkish as they are.
Okay, so let's talk about when you think they might pull the trigger on cuts, I guess, to be clear on that. I mean, cash rate futures, I'm looking at that, don't fully price a cut well into the first quarter of next year, if not the second quarter. When do you think they can move, or they should move?
That's I mean, the cash rate numbers, the expectations that have been bouncing around like a yo-yo. Earlier this year, the market had cuts starting in June. I think there was 3 cuts, 2.5 to 3 cuts priced in. Then, of course, just like in the US, those numbers have been wound back. I think over time, the money market will start to edge back towards an easing. When I last looked, and those numbers might have bounced around a little bit on today's numbers, today's decision, the market was about 50-50 on a cut by the end of this year, or maybe just below that. We think that we will see a cut by year end. November is the obvious meeting because that's when they review their forecasts. And I suspect that when they review their November forecast, they will review their inflation forecast down. That said, they could wait 6 weeks later to the December meeting. So, but I do think by the end of the year, we'll have enough evidence that the economy is very weak, that people are not spending those tax cuts that we get from July 1, and that weakness in the economy is leading to weak demand, obviously, and a rebalance of supply and demand, leading to less pricing power and lower inflation. Giving the RBA the confidence it wants that inflation will come back into target and therefore enable them to start cutting. But I would concede, there is a risk that it may be delayed till early next year. And of course, the money market is still allowing for that to some degree. But our base case is late this year, November, if not December.
Yeah, I'm just looking at a 3-year yields on the short end. Obviously, we're looking at a slight uptick. There might be some repositioning here in terms of just this hawkish. Maybe hawkish, maybe not. Maybe it's simply just positioning. Now, Shane, let me bring in external factors here. Let's start with, let's say, the Fed. Is the RBA in any way, in any material way, tied to the Fed's own timeline on rate cuts, you think?
Look, I don't think so. I mean, if you look back historically, the two central banks have often diverged. We started tightening pretty quickly coming out of the GFC all those years ago, whereas the Fed kept cutting. And then the Fed started tightening through 2015, 2017, when we were not moving. In fact, ultimately, we started cutting rates again. So we have diverged in the past, depending on the circumstances. But right now, the economic cycles are in alignment. So I think that to the extent we're seeing a resumption of falling inflation in the US and increasing confidence that the Fed will start cutting by September, I think that is a good sign for Australia, for Australian inflation, and for the RBA, that we won't necessarily be following the RBA, following the Fed to a cut in September. But I think if the Fed does move in September, to the extent that lower inflation in the US will probably foreshadow lower inflation in Australia, that will clear the way, I think, help clear the way for a cut by the Reserve Bank, at least by December. So, yes, they're not wedded. It's not the be-all and the end-all. We've seen other central banks diverge from the Fed, Canada, ECB, Switzerland, Sweden so far. But I think it would be a good sign if the Fed does move, and that would give you good evidence that Australia is going to go down the same path.
Shane, part of the statement, the bank is quoting rising home prices and tax cuts perhaps being able to support consumption growth. Where do you see home prices going?
Well, that's the big thing here. On the one hand, you've seen a big hit to household income, cost of living pressures, higher interest rates and so on. On the other hand, home prices have continued to rise on the back of a shortage of housing, and we get those tax cuts. So that does provide some boost via higher wealth and, obviously higher disposable income. I tend to think, though, that people will still save the bulk of the tax cuts. And in terms of house prices, yes, high immigration levels and constrained supply have been a big factor supporting the market there, and the gains have been reasonably solid particularly in some cities like Perth, Adelaide and Brisbane. But by the same token, the longer interest rates stay at these high levels, the greater the risk that more will be forced to put their properties on the market and will keep demand depressed, as we're seeing in places like Melbourne and Hobart and to a lesser degree Sydney. And I think that could result in softness in the property market, which again would be consistent with the Reserve Bank moving to cut interest rates. But I agree. Yeah, there are cross tariffs there, which at some indicators aren't all going in the weak direction, which makes things confusing, just as it has globally. You know, we've seen a bounce in home prices globally earlier this year. Some of those property markets have started to soften again, but it does make it harder for central banks.
Well, but here's another one, and I guess it's a final question here. So the RBA is also saying that the labor market continues to remain tight. This deep into, the tightening cycle. The last hike from the RBA, I think, was in October of last year, and we're almost moving into about 9 months from that, and still the labor market is tight. I think 4.2% is the median projection on the unemployment rate this year for private economists. What's your forecast on the economy broadly?
Look, to be honest with you, we're about 4.3, 4.4. I wouldn't be surprised if we get to 4.5, a little bit higher. I know the labour market is still tight. Unemployment at 4% is still historically low, at least in the context of the last 40 years. But it has been rising. It's been rising from 3.5%. If you look at the US equivalent of the so-called U6 underemployment measure, we've got 10.7% in Australia. That's people either unemployed or want to work more hours, which is still relatively high. So you could argue on that basis, there's still a lot of spare capacity out there in our labour market. But more importantly, when you look at job vacancies, they've fallen for 6 or 7 quarters in a row. If you look at ANZ job ads, another indicator of the same thing, it's down. Job placement agencies telling us that there's rising numbers of people applying for each new job ad that goes up. Hiring plans have softened. So it looks to me like the labour market is cooling down and will continue to do so, even though right here, right now, it's still fairly tight.
Shane, as goes without saying, as always, it's a pleasure to have you on the show and to get your insights. Sir Shane Oliver there, Chief Economist, Head of Investment Strategy at AMP. For our Bloomberg clients, you can turn more to your own Bloomberg, of course, to get more coverage, analysis, and context in the latest lines coming through from this RBA rate decision. TLIV Go on your Bloomberg terminals. Also on the Bloomberg is we're tracking market reaction to, of course, the big news out yesterday, China launching anti-dumping investigation and probes into pork imports from the EU. You're seeing a reaction across some of these pork producers in China today. Might this be the start of something of a tit for tat, if you will, across China-EU trade? Min Lo, our China correspondent, here with us to talk us through what sort of market reactions so far have we seen going into today?
So our economists have crunched the numbers, and it looks like this is not going to have a huge impact on inflation in China because China imported 1.5 million tons of pork from EU last year. They imported 1.5 million tons of pork globally, and let's say about half of that comes from the EU, just judging from the EU's share of global pork exports. That's only going to represent just 1.3% of China's total pork consumption. So it's still a very small sliver of the amount of pork they consume. And assuming, let's say, China imposed a 25% tariff on those pork, just roughly equivalent to the weighted average of the EV tariffs, that's going to cause pork prices to go up by 0.3%. And if you further dilute that in the CPI basket, it's only going to lead to inflation of 0.01%. So pretty much invisible.
You won't really feel it. Is this being viewed as a targeted, measured response?
Yes, so it's going to affect about $1.8 billion worth of goods, mostly coming from countries like Spain, Denmark, the Netherlands. But overall, China-EU trade stands at $280 billion. So this still represents less than 1% of overall trade. So it is seen as quite targeted. And clearly, China is being very cautious here because the last thing they want is to drive the EU and the US closer together in their anti-China stance, especially when China's economy is really relying very heavily on this export-driven trade to lift growth at this time. But still, this probe, it's going to take quite long until mid of next year. So still a long runway. It's likely to hinge upon the final outcome of the tariffs on Chinese EVs because that's only going to be decided in November. And the current tariffs that's going to be imposed in July, those are still provisional for now. So plenty of room for negotiations.
Min, thank you so much. Min Lo, our China correspondent. We are in the lunch break, of course, here in Hong Kong and up in mainland China. We reopen in about 17 minutes from now. Just to mention as well, pork producers are seeing a little bit of an upside today. Off-session highs, I should also underscore that point. Just ahead here in shows, we're looking at this price plunge taking place, maybe going into today, not so much today though, is sobering reality with Guizhou Maotai's flagship liquor and the price pressures we're seeing on the retail end might be signaling a headache for the Chinese economy. More on that story next. This is Bloomberg. This month-long shopping spree, 618 is June 18 or 618 is officially wrapping up today, although we might get some incremental activity beyond today, of course. Well, it might prove to be a short-term boom for retailers. Our folks at Bloomberg Intelligence think that China's consumer sales gain this year could fall 23% if you compare that to forecasts. Let's bring in Catherine Lim, our senior analyst, to talk us through this. Why don't we start with, do things really end today? Or like, do we get, if I miss it, if I'm busy, if I'm doing something else, can I get the opportunity tomorrow, say? Like, how is the window closing on me quite fast?
Well, absolutely, David. You've got another 2 more days to go. June 20, that's when Taobao, Tmall, PDD as well as JD.com, their sale ends. And if you still miss those 2 days, you have Kuaishou up until the end of the month to get your bargains.
Oh, perfect. And that sounds like an afternoon. We had the retail sales out yesterday, beating estimates in China. Did that surprise you, given where this holiday actually fell from a seasonal perspective, of course?
Right. Now, of course, the sales started, sometime May 19th. And so a lot of the promotions went in for the May retail sales. So the slight uptick that we actually saw didn't come as a surprise. And, I was expecting the numbers to actually be better. And it did actually come in, really on the back of the very steep price cuts, the promotions. It's not a surprise, but really it does bring that question to what if and when it all ends this month in June. And that is, I think, the reality starts sinking in for the promotions-driven consumption, which I think it will all go back down to, consumer sentiment isn't all that great.
Yeah, but okay. Well, what does it mean for the companies then? So we did get a boost, of course, during this specific period of time. So e-commerce, Baba, JD.com, PDD, of course, social media, you have Douyin, you have Kuaishou, as you mentioned, looking to monetize what's been going on.
Right, absolutely. So I do expect the GMV of these platforms, from the traditional e-commerce right to the social commerce companies like Douyin, Kuaishou, they should actually be getting, higher GMVs. I wouldn't be surprised if it comes in like, north of 10%. But then again, really, whether they are able to actually get that into revenues, because they were throwing out a lot of merchant perks, subsidizing merchants for the promotions, etc. It may not actually be as huge a gain to their top line as what one would expect. But let's see, because do bear in mind that Alibaba is on the hunt and trying to get its China e-commerce numbers growth to the double digit. So we're going to see whether they are successful on the back of the promotions that they've launched so far in 618.
All right, yeah, let's see. Absolutely. Catherine, fantastic. Catherine Lim, our senior analyst at Bloomberg Intelligence there. If you're wondering why Guizhou Maotai was showing up on the screens earlier on, it's certainly part of the conversation around the consumer and the health of the consumer. And really what you're seeing on pricing might be underscoring a sobering reality, if you will. The price of a bottle of the flagship liquor recently hit a record low. And according to Bloomberg Intelligence, that signals a slower recovery in consumer spending. Maotai, I should also mention, has only closed higher 3 times in the last month or so. Ada Lee's here with us, our senior analyst, to talk us through how we should be thinking about this price drop.
So in terms of the price drop, if you look at 2023 vintage of Fei Tian Maotai, which is its flagship product, it is currently trading at about 2,600 yuan per bottle, which is about 13 to 14% lower than the beginning of the year. So the price of what the consumer are willing to pay for a bottle of this liquor has dropped quite meaningfully since earlier this year. And I think when you look into this, you can see that the consumer demand is an issue, right? Because this is actually consumer demand-driven price, and I think that's why everyone is quite concerned at the moment with this price drop. But if you look at the company itself, it is actually still rather robust in terms of its sales. So first quarter, we saw 18% year-over-year growth in first quarter sales, and we're also expecting mid to high teens percentage growth for the rest of the year. So in terms for the company, it's still robust, but what the in terms of what the consumer are willing to pay for is another story.
Yeah, that's an interesting point, since people think about Maotai as a B2C company when, in effect, it's actually a B2B company that then some of its retailers then decide to cut the price. So I think its question there is the weakness in the retail sector, will that force the company to cut its prices at the factory gate?
I think that is a very good question, because they just raised the price last year in November. So they rose it by about 20% in November last year, the ex-factory price. And I think it is a bit tricky in terms of whether they're going to lower the price or not, but there are talks about potentially them buying some of the inventory back. So that could be an opportunity, but I think in terms of the prices, probably less likely to drop the prices.
Yeah, different type of stock buyback, isn't it?
Correct.
that
Liquid stock buyback.
Liquid stock buyback. What else is going in as far as the outlook is concerned? Is it looking positive or negative, or all things considered now fairly neutral?
I think for the company itself, it's still quite robust, given that, like we discussed, the ex-factory price is actually vastly different to what the consumer are paying at the wholesale price. So on a company level, it is still very robust till the end of this year. The only issue is, well, what if this inventory overhang will continue and then the consumer price continue to drop? Then what's going to happen to the distributor and the wholesaler when their margin gets squeezed? I think that is a major issue for Guizhou Maotai maybe in the next year.
Fantastic, as always. Ada Lee, our senior analyst at Bloomberg Intelligence. Just for context, right, 92% gross margin, 51% operating margin. Quite something. Okay, plenty more ahead here on shows. This is Bloomberg. A look at markets right now. So if you're just waking up, and in case you missed it, the U.S. cash market closed at a record high for a 30th straight time this year so far. So last time we've had this many sort of record high closes was in 2021. Although you have to go back to 1995 to really get a lot more. I think we pushed past the 70 mark back in that decade. Dollar, as you can see, slightly bid today. European assets going into the session today, so well behaved yesterday following at least more behaved yesterday following the dislocation in some parts of the market. And we're looking at some strength coming through as well as far as the oat futures are concerned, Bund futures, and also going into where you are the equity market-wise. It's also been busy, by the way, as far as the euros go. A lot of sports action. And speaking of, you might have missed this about 2 hours back, I'd say. The Boston Celtics won their 18th NBA championship, claiming victory against the Dallas Mavericks. 106-88 in Game 5. So the Celtics have now, they're standing alone at the top once more, breaking a tie with the Lakers for the most wins in league history. It also marks the 13th championship this century for one of Boston's big four professional sports franchises. So it's been good, hasn't it? All right, well, if you're there, hope you have a great rest of your evening. That's it from us here at Bloomberg Markets Asia. Hong Kong and China back from the lunch soon. This is Bloomberg.